You've waited all day for this. A textbook double bottom at a major support level. Everything looks perfect. Retail logic is straightforward. Place a buy order at the support line and tuck your stop loss below the recent lows. Then the spike happens. The market dips far enough to hit your exit before immediately reversing and rocketing 100 pips in your original direction. It feels personal. It's as if someone is watching your individual screen, waiting for you to enter so they can hunt your specific account. This experience is a byproduct of the Counterparty Rule. Large-scale institutional orders require high concentrations of opposing liquidity to fill, and retail stop losses provide that volume in a single predictable zone. The Forex market handles trillions of dollars in daily turnover, yet even at this scale, the deepest liquidity pools have limits. In any trade, a buyer must find a seller. For a retail trader buying a single lot, the market matches that order instantly with no visible impact on the price. At institutional scale, a bank attempting to execute a $500 million buy order cannot simply click a button without running out of sellers. The massive order eats through available sellers, driving the price higher and causing severe slippage. To enter a massive position without driving the price against themselves, these players must find a concentrated pool of market participants willing to sell at the exact same moment. Institutions let clean patterns form, building predictable order clusters. Every support buyer places a sell stop below. The Judas Swing pushes price below support, triggering these stops and flooding the market with sellers. Institutions absorb these exits to fill their massive buy orders favorably. These liquidity sweeps are often timed to coincide with high-volume sessions, such as the London Open, where the market frequently traps breakout traders before establishing the real trend of the day. Another high-probability window is the New York Silver Bullet session. Between 10 and 11 a.m. Eastern, the market often seeks out a secondary pool of liquidity before a major continuation or reversal. Recognizable retail patterns serve as high-density maps for institutional players, identifying the exact zones where they can generate the volume needed to build their own positions. Profiting in this environment requires a shift in timing. You must wait for the institutional players to clear the existing orders before you commit your own capital. First, identify a retail liquidity pool and wait for a sweep and close. You're looking for a long wick that pierces the support level to capture the stops, but a candle body that closes firmly back inside the range. Next, look for displacement on a lower time frame. This is a sharp move back in the true direction that breaks through previous structural highs, confirming that the institutional buy orders have taken control. You can then enter on the first retracement. Because the primary pool of sell stops has already been absorbed, the immediate overhead supply is removed, creating a path for the real move to begin. Stop hunts provide the volume that moves the market. By mapping these zones with FXNX's charting tools and timing your entries after the sweep, you can trade alongside institutional flow. Open an NX1 account today for 0 pip spreads and download our institutional liquidity zone checklist to start marking your charts.